versus selling that at the. Good afternoon. Welcome to another edition of the Educate to Trade podcast with me, Chris Pollock.
And me, Z.
Guess we should probably address the elephant in the room, Z. We are seemingly wearing the same top.
Absolutely.
We need to have a little chat in the morning about what we're wearing. This happened to me and Nick Jott a couple of weeks ago where we both embarrassed ourselves. So, hopefully we can sort this out for next time.
Absolutely.
Where do you want to start this week? Or is it last weekend? Where do you want to go?
So much has happened that we got to start from last week. So last week we left it on a cliffhanger, and we talked about Trump, we talked about gold, and we talked about different assets. But then leading on to Sunday, a big event happened, right, Chris?
Yep, bombs were dropped. US
dropped.
Bombs, not Israeli this time.
Yeah, US bombs were dropped. US sort of entered the warfield, and then Monday came with another sort of Truth Social sort of tweet. And we had more coverage on that sort of front, and that sort of leaded us into where we are in the market currently.
Yep. Yeah, so that's it. We had the bombs. You would have thought maybe gold, oil might have had a little bit of a bounce on this, right? Again, a little bit of a gap higher from Sunday into Monday. But yeah, again, a real lack of response from what you would expect to be the kind of most responsive assets.
It's becoming the new normal. That's why this week I've not been able to take a trade because my setups do not play into ranges, and I think this week has been rangy for most assets, other than S&P. I think S&P sort of made highs, all-time highs.
Yeah, should we ring the bell? The all-time high bell? Yeah,
Ring it.
We're back.
So that made all-time highs, and but there was some speculation why it sort of made the highs, and we were speaking about this earlier. And I think it's to do with the potential rate cuts.
Yeah, so that's it. Last week, we obviously had the Fed rate decision. Powell was on the wires, still kind of saying that he's not fully informed about which direction we're going to move things in terms of rates, when we're going to do the cut. The market was pricing in the second half of the year. But because the Fed have now had their say and Powell's had his say, now the other Fed members are out of their blackout period where they can't talk to the media. So up they pop. We had Bowman on Monday suggesting that we could there might be justification for a rate cut as early as July. So that kind of started the week pretty nicely for the stock markets. The ceasefire on Monday probably helped. There's probably some geopolitical push on there too, but certainly from a rate decision basis, we're pushing higher basically on those Bowman comments and have been the whole week. I mean, Daly was on the wire. She was having a slightly different view. She was saying it was going to be a fall cut, which for those of people who don't understand that, an autumn cut. So she was pushing it a bit further back. So it has kind of mediated that possibility. But last week there was an 8% chance of a rate cut in July. Now I think we're around 20-21%. It was as high as 25% yesterday, priced in by the Fed futures market. So a marked change, and maybe we get a rate cut before the summer. It doesn't sound like something Powell would want to do because there's that extra stretch between July and the September meeting. They have a couple of extra weeks off. So maybe you'll like to see how these tariff deals, which again we're getting very close to, the end of that July 9th window is getting rapidly close. Maybe we'll want to see how that all settles down before making that rate cut decision, maybe September.
I've seen in the market sort of countless times where sort of speculation arises and then sort of the markets price itself in. So when I look in S&P sort of making its highs right now, I think that's how it's pricing itself in before the rate cuts. So when the rate cuts do happen, we make a high and then we chop.
Yeah, well, buy the rumor, sell the fact, right? This is like a tale as old as time in trading, you know?
Yeah.
You don't necessarily want to be trading the news. You want to be trading the anticipation of what the news is going to be if you can get some insight. So yeah, markets move on these slight changes to expectations more than they do sometimes on the actual news, you know? So yeah, maybe we're going to see this push and push and push. I mean, my feeling, I know we talked about the option expiry last Friday, that being like the triple witching, quadruple witching option expiry, one of the big ones. But with the S&P being so close to all-time highs, I think we mentioned this last week, maybe it just wants to go and nudge them. Yeah. And then we can see what happens now. And we've done that today. S&P or the SPX cash market, if we have a look over to the charts here, this has finally taken out that high from mid-Feb.
Wow.
So all this big washout and the Trump tariff announcement and then the U-turn. And I think we did a podcast maybe at the end of April and we were talking about if he can just keep his mouth shut, this market can keep going up. Well, he's relatively, by the war, managed to keep himself out of trouble. And lo and behold, stocks go up and to the right. That's their nature. And here we are, all-time highs today on the S&P. So yeah, I think you're right. I think it's pretty much rate expectations related more than it is ceasefire related. But yeah, I'm curious to see how this day ends because are we going to see like a conviction, high volume move on this, or are we going to get a little fake out to the upside? Yeah, well, time will tell, I guess, as we go into next week. Maybe we'll have a clearer answer next Friday.
Monday and Tuesday, I was looking into the US stocks. I was looking into Meta, I was looking into Nvidia, and I was looking into Microsoft, and they were all making highs. And when I see, so Monday to Wednesday, when I see US stocks start making sort of highs, I could anticipate that the index is going to sort of move as well alongside it, but it sort of has a delay. I think what I've normally seen, I've seen US stocks go up, and then I see it eventually catch up onto Nasdaq, into S&P, into Dow Jones. So I think it played well this week. I mean, we had the ceasefire, we had the announcements. Hopefully, a peaceful time in the Middle East for our folks here.
Yep.
Right, and what that's done for the markets is it sort of priced itself in with rate cuts, with everything upcoming. Today, Chris, I want to do something a bit different.
Okay.
Yeah, today, because I didn't trade as much this week, so I became very philosophical. When you go away from the computer for a little bit, you think about how you trade, what data we look at. So today I want to do that with you. I want to ask some, because I think a bunch of traders here were doing that. They were pricing some questions to me, and they were like, could you get these questions answered?
Okay, let's see what I can do. All right.
So the first question, right? So we're currently in a range, as you know. So what's your process for spotting when the markets are about to change direction?
Yeah, I mean, this is the essence of trading, right? This, if you can find turning points in trades, I mean, these are the best times to trade. If you can buy the low and sell the high, you know, you kind of cracked it there, right? But I mean, there's a lot of false signals out there. But I mean, order flow for me is the way to look at this. If you have a market that's going up on volume, on buy volume, that's more likely to continue than a market that's going up on no volume or more sellers. Believe it or not, markets can go up on more sellers. Not for too long, but it is something that happens from time to time. So, yeah, I'll be looking at the volume, the order flow, cumulative volume delta. Got myself a little CVD by at C volume profile made this week that kind of ticks the boxes for me on the cumulative volume delta, which a few guys have, quite a few positive feedbacks on that already. So, yeah, if you like cumulative volume delta, look out for that one. Yeah, very much helps you as long as you're using the futures contracts. Don't be using some broker contracts on the trading view for that. Yeah, use the future stuff, and I think that can really kind of tell you a bit more about the story rather than just the surface and the price. I think price plus volume just adds a bit more depth, and that's what I look at.
With me, it's sort of footprint charts, CME data, but CME group data for like active strikes. I think that sort of gives me a lot of adjustments to my sort of range and my sort of lines on the chart. I think I use that sort of data as a confirmation. And I think traders should start to look into external data like that and not just worry about the candlestick and patterns.
Well, that's it. Yeah, the option stuff's really good because it's all about liquidity. It's the way that we both trade, I think, and most people in here trade through liquidity, whether it's kind of volume profile, order flow, deltas. But then you've got future liquidity like the DOM, where the option strikes are. These things are kind of future liquidity levels. Just the nature of the options market means at those levels actions can occur, predictable actions. And that might be why 6200 is in its sights today on the SPX, because we got that as not the large call wall for the open, but certainly after half an hour or so, that 6200 was flaring higher. So I think there's a lot of appetite for calls at that price now. So if we get there, maybe they cash them in. Maybe that's the high today. Keep an eye out.
Like last week, that's one thing I was looking at. I was looking at CME Group data, and when I saw the call wall sort of taking up the direction, I said we need to really look at this price.
Yeah.
And could this be the sort of all-time high that we hit? And sometimes by looking at that call wall a week before, right, we anticipate things. And when we see sort of an increase of orders at that level, we know that the markets could eventually hit that. So that's a great sort of answer to that question.
I think we should probably explain what a call wall is.
We should.
So people who aren't familiar with options, you have call options, which are bullish plays effectively if you're buying them, and then put options are bearish plays if you're buying them. And a call wall is the place at which the most calls have that strike price. So if you have a strike price at 6200, as we do today, that's the place currently with the most calls. The idea being, if the market gets closer, the people who have sold those calls probably need to hedge themselves, and that will mean they buy the futures, which nudges price up. As price goes up, guess what? They need to hedge themselves some more, and the price has to nudge up with some more buying. But then when it gets there, maybe these guys at the money, this is an optimal place often to kind of cash in your option trades. At the money, often some of these calls get sold and profits get taken, and then these dealers have to pay from all the money they've made on the futures these guys out, and that can create a bit of a kind of vacuum in price from those levels. So yeah, 6200 today, worth a look if we get up there, I think.
So the next question is a bit similar to the previous one. How do you adjust your bias when the market is ranging or trending?
Yeah, ranging. I mean, I'm quite short term in my trading, right? So, yeah, one person's range to me might be quite a volatile period because I'm looking on the quite short term. But typically, if you're in a range, sideways action, you just want to trade extremes, right? So volume profiles can be really useful. You can wait for like 1-2 standard deviations from where the volume was traded. And just try and kind of look for reversal signals, trap buyers, trap sellers, breaks of the value area highs and lows, like failed breaks. These things can be really, really helpful in ranges. With trends, the volume profile is also helpful with the point of control, right? You can bounce off that on a trend day. That's kind of how the market moves. So you can use the same indicator, but use different signals from it. But yeah, if you're trading in an uptrend like this, it's BTFD, right? I mean, this is the story of stock markets for my whole trading career. It's just when it gets its ass kicked, just buy it.
Yeah.
Or I saw a statistic. I know Jerry, one of our contributors, put this out this week. I think there's been like 100 times since, I don't know what year it was, 2012 or something, that CNBC have done a markets in turmoil special. Had you bought the close of that day, within 6 months, you would have been up with a 100% win rate. An average return of 40%.
Wow, that's big.
So the stats maybe aren't quite there in terms of the number of trades and when it began, but I think it was it was definitely 100% win rate, and I think it was over 40% returns. So yeah, amazing. You just want to buy the dip.
The dip.
So this is kind of true if you scale it down into a shorter term trend. You don't want trend as your friend, as they say. If the market pulls back in that trend, the week longs get flushed, you can pick up some of those positions, and then hopefully you get the trend continuation. If not, that's what stops it for.
So this is a question that sort of, because I go through students here, and whenever sort of we look at footprint charts, we look into things in that sort of directions, they make a bunch of mistakes when they're observing the charts. So that sort of leads me into the next question, which is, what common mistakes do a new futures trader make when reading order flow?
Very early, I found people find it hard to distinguish between the market orders and the limit orders. So when you see loads of buys at the high, you're like, why the hell is this not going up?
Yeah.
And then when you actually think about what's happening, those guys who did those buys are buying from liquidity. Liquidity typically is provided by the bigger institutions, because they're the ones like market makers. The biggest hedge funds in the world aren't going around clicking buy and sell, right? They've got levels. They obviously scatter these in with iceberg orders these days, but they're prepared to kind of, if you want to buy from me here, go ahead. You want to buy 50, buy 50. You want to buy 100, buy 100. You want to buy 200, buy 200. And eventually the buyers go, I've got no more bullets. But the big institutions are like, well, I do. and this is how trap buying happens. So like just understanding that on the buy side, it might look like there's buyers and it's gone down. You're like, hang on a second.
Hang on, yeah.
What's bullish though? Because of the buying. It's like, no. These guys are trapped. And that's the sign. It's like the old days of being on the floor of the pits where you see Goldman Sachs walk in and start going, oh, it's high enough now. I'm selling here. And like, okay, you can be a novice day one. Just go in there and go, yeah, if Goldman is selling, guess what I should be doing?
Absolutely. So like footprint is one of them things that when sort of new traders see it, they think it's amazing and it sort of predicts markets, but what it really does is sort of you anticipate moves. And then when they don't go your way, then you're like, I'm reading this wrong. And I think it takes a bunch of experience with footprint. I think it's taken me a whole year.
Yeah, I mean, I don't like short-term footprint charts in isolation.
Oh boy, no.
I think you've got to have a model of some sort, which is kind of bigger picture. And you can use bigger picture footprints to kind of get those longer-term levels in for sure. But just using it as a filter for any trade, whether you're doing breakout trading, RSI divergence, whatever, moving average crossovers, whatever it is, really simple things you can do and add in order flow, then it can just confirm which trades are most likely to work and which ones are least likely to work. And in my opinion, if you use that with anything, your win rates will go up.
Brilliant. Yeah, that's one common mistake most traders make when they're looking at footprint for the first time. I've seen that, and I've had to like sort of explain them limit orders. Sort of become a teacher. So no, I appreciate that sort of answer there. Now the other sort of questions, as we know, 90% of trading is psychological.
In the end,
it is. It's like 90% psychology and how you sort of read and anticipate the data. I think I'd say is relevant to 10%, and most of it is how you hold that trade. So now the next questions are sort of because we have to think mechanical here. The question is, how do you handle drawdowns and losing streaks?
Cool. Well, drawdowns are inevitable in trading, right? You can't put a trade on without taking risk. And if you take risk, at some point, you're going to lose a trade, right? This is just the nature of being. And in fact, with trading, you really want to set the easiest way to make money as a point-and-click trader is to have a system that loses more often than it wins. But when you win, you make a lot more money than you lose. So, yeah, drawdowns are inevitable. You will deal with them. And actually, the quality, arguably, or maybe that's not the right word, but the ability for you as a trader to succeed long term is all about how you deal with drawdown. So how I do it, I have like circuit breakers. I was talking to Taylor today about this a little bit. If you're in a drawdown, let's say 2% drawdown from the highs on the account, I'd just take a day off. I'll go look back on the trades that took me from that high to where I am today, and then I'll try and I'll not do this on the night of the trade losses. I'll go to sleep, come in the next day, choose not to trade, look back on what I did, and then I'm a little bit detached from what happened, or less emotional about it, and I can more objectively see, was I doing the right things or wasn't I? And if there's two kind of answers to the question when you look back this way, it's either A, the markets, I would have taken those trades again, in which case the market isn't working for you. Options then include trade on demo for a bit until they do. Right, you might be in a really choppy period where your system isn't going to work. Why just keep rolling that dice if it's proving at the moment it isn't working? Maybe wait for the demo account to show you that your system's working. It rebuilds confidence, and it stops you from going too deep on your drawdowns before your confidence grows again.
Absolutely.
So that's really good. The other one is you've been trading like a prick.
Yes.
And you've not been behaving correctly. And arguably this is an easier fix. Just stop trading like a prick. But that extra day off gives you that little slap around the chops. And then you can kind of go, okay, well, I've given myself the day off, I've recalibrated, gone play golf, whatever it is at the moment you can do. Just get a break, come back the next day and go, right, here's my trading plan, this is what I'm doing. Yeah.
Like one advice I gave one of these students the other day was, you need to think of it as a mechanical sort of module, like a game. You cannot think of trading as an emotional attachment. I think most folks, when they sort of have a winning streak, they're sort of bright and sunshine, and they're sort of in the best mood of their life. And then when they're on their losing streak, when they're like 3 to 4 trades into their losing streak, they're very miserable.
Well, Kipling wrote a poem, which has a really good line about this. If you could meet with triumph and disaster and treat those two imposters both the same, this is trading, right? There's so many things in there that traders all around the world have that plastered on their screens, right?
Absolutely.
But that's a really good takeaway. If you can have a really big winning day and you walk out feeling exactly the same as you do when you hit your daily loss limits, you kind of crack psychology, or at least on that day you did. Just trying to get into that. The outcome is the outcome. You cannot control the outcome. You can only control your process. But people, to begin with, get the dopamine hit when it goes well, and they get a real kind of gut punch when it doesn't. And it takes time to get over for all traders. Very few people are naturally able to do that, but that's where you need to get to in the long run.
So, Chris, the question is, how many years have you been trading now?
2006. So what's this? 19. I'm in my 20th year now.
20th year, right? And so in the 20 years, if you were able to go back in 2006, 7, 8, go back to the years, and you ask your younger self this question: what's one trading lesson you wish you learned earlier?
Oh, easy. Daily loss limits. Daily loss limits. This is the aim of the game, is to stay in the game. Right, and if you and I've done this, I've been guilty of this, where I've lost trades, I've had losing streaks in a day, and I'm like, through blood, sweat, and tears, I try and make that money back, and I do. And then this happens again, and I have a 1% loss on the day. I need to make this money back, and I do. After time 6, you go down 1%, you try and make the money back, and you don't, and now you're down 3, and you try and make that money back, and you don't, and now you're down 10. That was the biggest lesson. I think it's the lesson that the majority of traders, if they just did that, they may just be profitable already.
I went through that in November.
Yeah.
So November, I think I was here at the trading floor with you, and I lost quite a bit. I lost I think 8% that month.
I mean, it
was a really bad month because Trump came in, and what did Trump do? Trump changed the market structure. And we were sort of playing our ranges, and now we're into a sort of a trending market. So every sort of buy and sell that I make went against me, and I had to learn it the hardest sort of way possible. But that was sort of life lesson I'll be taking for the next decade or so.
Well, that's it. If you do a NASDAQ contract during Trump periods, you need a 100-point stop. You're talking about what, 6-8 grand or something per trade. So a 15-point stop isn't going to cut it when Trump's talking about tariffs or what's
Oh boy. The second he started to tweet, it just changed the market dynamics. I mean, prior to that, I think it was September, October, we didn't have that sort of encouragement from Biden and his sort of speeches or anything coming from Powell as much. It was just the ranging markets. It was a sort of condition we got accustomed to.
Yeah.
And then Trump comes in, and then we should have studied 2015-16 when he first came in. He changed.
Well, this was more wild than that. This was even more wild.
It was wild, because even in 2015-16, it was they were I called them easy longs to catch at the open, and then I was sort of anticipating that with the range, but no, these longs were just off.
Yeah, the Trump 1.0, he was send something on Twitter, so you don't even need a Bloomberg terminal. Just send something on Twitter from his golden toilet in the Trump Tower, and bang. Everything was bullish stock markets, because his game was to try and pump the stock market. So you just see Trump tweet, bang, you buy. That was the game. It was easy.
It was an easy
This
game.
one was like, wow, this guy is slinging this market, or not up. He didn't care. He was trying to sort the bonds out, and he failed, at least for a while.
So now I'll sort of ask you one last question.
Cool.
And then we can have a great weekend. But who or what influenced your trading style the most?
Who or what? So maybe what was when I moved from more long-term trading to short-term trading, and I saw like the kind of fib, Elliott wave sort of theories I'd used in these kind of position trading that we used to do, really not work on the short time frame. So that kind of really influenced me to go, right, how do these, in the short term, what's going on in these markets? Why are they not following these patterns? Because the idea with Elliott wave theory is this 5-move pattern and 3 moves back. You can get this down into the nanos, right, is the theory. In reality, it's a bit more complicated than that, and especially in the very short term. And in the short term, I can't remember when this dawned on me, maybe 10 years ago, markets are looking for liquidity. And as soon as that kind of light went up, that bulb kind of struck in my mind, it was like, right, where can I get liquidity information from? And that to me was kind of, certainly from a day trading perspective, the best thing I ever did.
Like when I started trading, I think it was... I came with 2 modules. One was sort of the candlestick chart. That was sort of the Japanese candlestick. And then the second thing was Wyckoff schematics, if you remember Wyckoff.
Yeah.
And what's happened is, I mean, we still do have Wyckoff schematics. We still have distribution, and we have these sort of, lower supply. We have these levels happen. But what's happened is now the algorithm has been fed in. Like there's more traders in the market. There's more institutes in the market. So it sort of sped up the market, and it just changed the complete structure. Because back then in the sort of 80s, 90s, and early 2000s, you'd still get those sort of patterns.
Yeah. I guess that's something to think about. I haven't really thought about that all of this high frequency trading, it wasn't around when I started trading. Really, it is very much taken off the last decade or so.
So that's one sort of lesson for the students here. When sort of students and the new traders are studying these modules, right? Because that's what they study. They study patterns like candlestick patterns, Japanese candlestick patterns, or they study Wyckoff schematics. And then they come into the Nasdaq or they come into a gold trade, and they're like, "This is not doing what the pattern's supposed to do."
yeah. There's a lot to learn in trading, but it's a good business when you can take your time and just find a structure that suits your personality, right? I know we talk a lot about order flow and what have you, and talking about Wyckoff here. Find something that you understand and that you like and that makes sense to you. With good risk management, you can make something work within that framework. Absolutely, no doubt in my mind. And if you can't come to us, I'm certain we can help you.
Absolutely. So one conclusion that will come out from this podcast, and I think we should do this more often. I think students can get a lot out of this. A lot of traders can get, because we've made all these mistakes, right? We
learned the hard way, didn't we?
We learned the hard ways. We got attached to our winners, and we got emotional on our losers. Yeah. And the conclusion is, no matter what your trading style is, it has to be mechanical.
To begin with, I think so. I think you've got to get, wet behind your ears a little bit. What you've got to do mechanical to begin with, just to kind of get a feel for how the volatility works, and over time you can maybe become a little bit more discretionary. Can't remember who was it, Ed Sakota, who said, you've got to have a trading plan. Good traders always trade their trading plan, but they also know when to break it.
Absolutely.
So this is kind of, I guess, like Trump would have been a good time to break the plan. We're trading Nasdaq with a 20-point start would have been a good time. Know when to break that. Maybe after the first couple of days, go, hey, this strategy isn't going to work right now. Hit the micros.
Absolutely, the micros hard. Now, sort of every week I leave you, and then I see you on a Friday, and so much has happened in that week.
Yeah.
But the sort of stuff that happened this weekend took us by surprise, right? The dropping of the bombs, the ceasefire on a Monday, it was all sort of instant. So my question to you going into the week following now is, are there any upcoming economic events or data releases that traders shouldn't ignore, that they should keep their eye on?
There's next week, if we have a look at the calendar here. If I can just grab the mouse, let me see if we can get it up and running. Thank you. Next week, first week of the month. So let's ping on here. Take a look at the calendar for next week. It's always non-farm Friday, right? Well, not next Friday. It's non-farm Thursday.
Wow.
Yeah, unusual, right? But that's because it's the 4th of July. Friday the 4th of July, hopefully the weather holds out, might be a little bit of golf in there, if not Thursday afternoon, but this is something I'd be wary of. A non-farm payrolls right before a big US holiday, to me, this could be a dangerous one without too much follow through. So this is the one to follow, but maybe follow it in a way that you don't hold your trade till the close. I feel like the volumes could easily drop off as people are shooting off to meet up with their family members for the weekend. You're from the States, right?
Absolutely.
So you know all about this. It's a big party out there.
It's a big party out there. I'm getting a lot of my sort of family friends and stuff call me.
Yeah.
Because in California we do have a huge barbecue, and we do have the fireworks ceremony and the parades.
Yeah.
And that's being in London. London's a blessed place to be in as a trader, because I get to trade both London and New York. But I do miss the 4th of July. I do miss the fireworks. I do miss the parades. Celebrating
your escape from British rule, right?
Absolutely. Tea party.
Look what's happened to you since.
What's happened now? I've come back. So we have unemployment rate next Thursday, and then we have 4th of July.
Yeah, so I think this is going to mean it's potentially a bit of a weird week. Skew it to the front of the week again. I mean, that's 2 out of 3 weeks we'll have had now with big US holidays in them, so it's not ideal. But when we're through this, okay, we'll have a bit of a better run, hopefully, through to Labor Day, early September, where we're not getting interrupted quite so much. But then the following week, 9th of July is another one. And to answer your question, right, coming up, we've got to get these decisions made. Between Europe hasn't made any progress yet in their trade deals apparently. So yeah, let's see what happens with these tariffs. Maybe they'll be back on the agenda soon. Good God.
Wow, so we have a big week coming up ahead.
Big couple of weeks, yeah. But enjoy your break next Thursday, Friday.
Absolutely. Appreciate you, Chris.
Pleasure, Z. Well, thank you for joining us on the Educate to Trade podcast. I've been Chris Pollock.
And me, Z.
We'll be back next week.
Thank you.